Hello and welcome to Building the Premier Accounting Firm. I'm your host, Roger Knecht, president of Universal Accounting Center, and this is a podcast dedicated to helping individuals start and build the premier accounting firms in their area, offering quality accounting services, bookkeeping, tax services to ensure that their clients are getting the information they need to run their businesses and obviously be profitable. Now, it's in this episode or the episodes that we air that we cover a variety of topics. We're covering things ranging from marketing, pricing, selling, quality services, mental health, training staff, and so much more. Each and every week we have on the experts to actually share various things that we need to be aware of as we're running our businesses and trying to service our clients and in fact build the premier accounting firm. Now, as every episode, I want to have a guest on that actually has something to help us do better, and this is going to be no exception. Sarry Ibrahim is a financial planner, a member of the Bank on Yourself organization, also known as Infinite Banking Concepts. Sarry, welcome to the show.
Hey, Roger. Thank you so much for having me on. I appreciate it.
Yeah, this is going to be a good conversation. So first of all, obviously, your background isn't accounting, but I'm assuming you work quite a bit with accountants. What is it that you have found interesting about accounting professionals and how they complement the financial industry?
Yeah, definitely. I mean, every financial plan needs accounting opinion or an accountant to work on the financial plan. Like, for example, we do a lot of strategies that involve annuities and cash value, life insurance, and other types of financial and insurance products that need an accountant's perspective, right? Especially a CPA or enrolled agent, right? I'm not a tax professional myself, so I can't go further into like tax deductions, qualify for tax credits, especially like depreciation on real estate and other things like that. So definitely, I think they go hand in hand. And I think every financial professional needs at least one accountant on his or her team, and vice versa. Every accountant needs at least one financial professional on his or her team.
I like that. Yeah. As I've worked with many clients, one of the things that I have found from the accounting perspective is with the client, they see that they're making money and they basically run into it in two ways. One is personally, whether it be W-2 or dividends, they're making money and they see how the company is helping them become a little bit more financially successful and live a lifestyle that they were hoping for. Likewise, the company starts to become profitable. And so there's two situations of, okay, what are we doing with the monies that we're earning, the profit that the business is generating, the earnings that the individual is receiving as owner of the business. And obviously, it just gets to the point where as an accounting professional, we have to defer to the financial planners who are experts in now what to do with this asset. We've got money. What do we do with it? Typically in those conversations, we're having conversations about 401ks. We're having conversations about HSA funds and all the like. But for the owner, it's, okay, now I've got this nest egg. Where should I be putting it? What should I be doing with it? And I think this is going to be a great discussion. So one of the things that I wanted to begin with is I know that you have this concept of bank on yourself. Mm-hmm. Tell me about that.
Yeah, definitely. So bank on yourself was invented about, I would say 20 years ago by Pamela Yellen. It was originally introduced in her book, The Bank on Yourself Revolution. And in the book, she talks about some of the downsides to 401ks and IRAs and mutual funds and index funds, kind of the traditional outlook, the traditional financial plan model that a lot of people are using, kind of the downsides of that, and more particularly towards risk, right? Like, how risky is it to put your money in the stock market? And is there an alternative? Like, do you always have to lose money when there's a market crash? So in her book, she talks about, is there a way that you can outpace what the market is doing, outpace inflation, still come out ahead? And there is, using one type of vehicle the vehicle itself has been around for over 100 years. It's use of properly designed cash value whole life insurance. And a lot of people, Roger, are like a little bit surprised when they hear like cash value whole life insurance. They thought we are going to talk about accounting and financial instruments and products. And here we are talking about life insurance. So it is one of the only vehicles that allows tax-free growth and growth regardless of market conditions. So I think that this is beneficial for the accountants who own the firms, and if they could use the bank on yourself strategy as business owners in their firms, as well as if they could share this with their clients. I think from both angles, from the owner standpoint as well as the client standpoint, this could be really beneficial and a big game changer in the industry.
Yeah. So when it comes into insurance, I think this is one of the things that as a client, they may not expect that an accountant is going to bring up or advise. But I know with some of my clients, we've had conversations about keyman insurance.
Mhm.
Keyman is basically meant to cover that if a very important person within the firm or within the company is to pass away, obviously we've got to deal with some things such as those shares that they own. How does the other partner buy them out from the spouse and not have to worry about the spouse coming into the business? I mean, Keyman Insurance has a definite place for the certain specific situations. What you're also now describing is how do we then leverage insurance to outpace inflation? And admittedly, that's a very common topic today with the inflation as it is. Is this a viable way to outpace what we're experiencing in the economy right now?
Yeah, definitely. Outpacing inflation as well as protecting a hedge against risk, right? So, one of the common things that when people hear about whole life insurance is they hear, well, I heard the returns are like, 1% over like 30 years, I'll lose money just based off having the money in the policy. And the reality to that is that typically applies to policies that are not properly designed. So if the policy is properly designed from one of the companies we use in a certain way, we could structure it so that way it could provide like 4 to 5% compound growth year after year, with the dividends that are not guaranteed but highly certain, and guaranteed interest in the policy that'll grow. And that way you can then save cash. And then it brings up the other topic now of, well, if I have my money compounding at 4 to 5%, I could put it in real estate and get 10 to 15% or some other places, like, or back into my business. And the kind of the cool thing about this is that you don't have to choose one type of investment over the other. You could fund this whole life policy, this properly designed whole life policy, and then borrow against the policy to reinvest in your business, to invest in, if you wanted to invest in the stock market, you could take that money, invest in the stock market, put it into real estate, start another business, be a limited partner in another business. So there's a lot you could do. You don't have to choose one over the other. And I think that having those kinds of strategies will definitely outpace inflation, and more importantly, create a hedge against your losses, because the element of losing in investments is, I think it's underrated, or it's not really considered that much. Because if you have an investment, right, and you lose 10% and then you gain 10%, you're not back where you started, right? You're actually still at a loss. If you lost 10%, I think you need like 12.5% to go back to where you were. And then it keeps growing. If you lose 50%, you need like 120% to go back to where you were. So just kind of basic math. And I think a lot of people don't really look at it from that perspective, especially people who only have investing experience in retail investing. I think that's like a huge difference. So, and you're right to your point, like it's not going to be common for an accountant to recommend life insurance to his or her clients. But I think the tax part of it, the growth, how the policy grows tax free, how the loans could be tax free, the withdrawals can be tax free, the asset protection within the life policy. I think all of those factors, I think, are worth at least introducing to the client. And the accountant has to be an expert in a certain area, so it makes sense for them not to be experts in life insurance if they've always been experts in a certain type of tax practice. But this is where referral partners come in, and I highly recommend that they at least have somebody that they can refer to, somebody they trust. And I know that's a whole subject in itself, right? Just the referral partners within accounting firms.
Yeah, well, something that I can share here that I think would be applicable, and the listeners, I'm sure, would appreciate knowing this. Well, not appreciate knowing it, but at least find it interesting, is that in our own company, one of the things that we've done to retain some of our key managers is we've offered them a similar type insurance policy, wherein the company is the owner of the policy for a period of time. In this case, it's a number of years. And after the employee has vested after so many years, they will then take ownership of the policy, and it would be for their own family. So initially what it is it's for the company to replace this person. We obviously have someone that is very key in the organization. It's not a key man policy, but it's similar to one. But the point is once that policy has been vested, this individual is going to then have access not only to the funds where they can, like you were describing earlier, take a loan from the policy and use that for personal reasons, but at the same time it has a death a death benefit that right now the company owns, but soon after they've vested, their family will own. And it's basically for employee retentions in the sense that it's a great policy and it has worth, but it's only if they stick around that they then get access to it. So it's meant to actually solicit some loyalty and longevity of the employee because they definitely want to stick around and through their tenure acquire this policy. Does that make sense? Are you familiar with what I'm describing?
Absolutely, yeah, definitely. And a lot of our clients have used the same strategy. Like you can set it up so you own it for 5 years or 10 years or however you want the agreement. That's kind of the cool thing about these policies.
Yep.
They're far more flexible than like 401ks and other 403b accounts if you're not for profit and things like that, because it's technically not a qualified plan. A life insurance, it's a tax advantage plan, not
Mhm.
necessarily a qualified plan. So that's good because qualified plans have a lot of kind of red tape and caution tape. There's a lot of things you have to follow. They're very costly. With these policies, you're flexible. You don't have to offer them to all your employees. You could, pay in more for certain employees, like the key people, the executives. And then you're right. And most importantly, there's a vesting period. So that's really important because if you have an employee right now that's making $100,000 a year, and then a competitor offers them $120,000 a year, they might just leave and say, I would go somewhere else and make $20,000 a year extra. But if you're offering them $100,000 a year and you have this policy and they'll get to own this policy with X amount of dollars, I don't know what the math is, but let's just say X amount of dollars in 5 years or 10 years. Now there's more to look forward to by staying with the company. There's a bigger reward for staying with the company for a longer period of time. So it's beneficial for the employee because they get that benefit. And it's also beneficial for the employer because now they don't have to worry about the employee leaving for whatever reason.
Exactly. So what we're doing, obviously, as a company, is paying the premium in
Mhm.
the interim. As we pay the premium, the policy is made whole. They're going to have access to the equity in the policy once it matures and they've vested.
Mhm.
So there's a lot of incentive for them to stick around versus, I'm going to leave the company and go somewhere else for $10,000 or $20,000 more, as you were showing. So
Mhm.
it's just a way to try and retain some key individuals, and then you have your key man insurance. That's a different type of policy, but very similar. But I think what it's doing here is we're addressing two things. One, whether it be for us or for our clients, we're trying to leverage what other tools, resources are available to take advantage of that would be beneficial to the business,
Mhm.
the owner, or the owner's family. And I like this conversation because I think this is a nice way to think outside of the box. And as
Mhm.
you think outside of the box, you'll find wonderful opportunities that you can implement not only in your own firm, but as well bring to the attention of your clients. Because as accounting professionals, we're helping them realize these profits, make these monies, and they're always going to be wondering, well, what can I do to maybe minimize my tax liability or mitigate my tax liability? Well, this is one of those strategies that you can use to purchase something that would be beneficial to either the business owner or their family. And I like that. So, what changes have you seen in the traditional accounting model that apply to this?
Yeah, definitely. So I think that, and correct me if I'm wrong, Roger, but there's been a lot of changes as far as technology, right? So like a lot of people now, it's very common. I do a lot of financial planning meetings and financial analysis meetings with clients, and there's a section in our financial questionnaire. There's a section where, do you have an accountant? And lately, I've been getting a lot of no's, like, no, I don't have an accountant. And then I ask, well, how do you do your taxes? And they say TurboTax. So that's I guess a big problem now is there's a lot of technology, not just TurboTax, but other similar companies who are really taking up the industry. And then there's also the rise of virtual CPA firms, the virtual accounting firms, which I somewhat promote that, right? Because I have a virtual practice myself, so I see the benefits of doing that. But if you're a local accountant, you can kind of expect to start seeing some business slow down due to the virtual world. And I think some of the ways that I interviewed, I don't know if a gentleman part of Elite Resource Team, I interviewed him on my podcast, and he helps financial advisors create partnerships with CPAs and other tax professionals. And in the podcast episode, I forgot what it was. It's on our podcast called Thinking Like a Bank podcast. He mentioned that CPA fees, accounting fees, are being compressed due to the rise of technology, right? So there's a lot more competition. The accounting space is becoming more commodified. It's more about pricing now. And one of the ways to counter that, or kind of hedge against that is to offer other services like investment services and financial products and insurance products. Because number one, it increases your revenue for the accounting firm. Number two, it increases retention. So you have people staying with you longer now. And then number three, it creates residual income. So every time, so a lot of accounting work is based off of in the moment fees under fees, service fees, right? So like you do somebody's taxes, you charge a fee for that. You do somebody's payroll, you charge a fee for that. You give somebody tax advice, you charge a fee for that. But with the insurance and financial products, you can earn revenue without necessarily working that day on those clients. You can earn residual income and renewal income and recurring income and things like that. So kind of those three benefits, just to open to the audience, if they've probably already been approached by insurance agents and financial advisors looking for referral partners. But I think those three reasons are really big, and definitely I see that even changing further in the industry just because of more technology. You look at TurboTax, how many tax returns are filing every year. It's increasing every year. Their revenue is growing every year. So it's becoming more and more normal now to do your taxes on your own, even without being a tax professional at all.
Yeah, I don't know how many of my listeners would identify with this, but I'm sure many will, which is as the software, the programs, the technology evolves, what we have is a lot of people, especially the younger, who feel that they can just kind of self-administer. They can self-diagnose their accounting, bookkeeping, tax situations. And so some of these things become appealing, and there's that shiny object of, oh, well, with this, I can actually take care of, let's say, filing my tax return. So I do believe that's what's going on, and that's one of the challenges that as an accounting profession we face, which is we need to do a much better job of articulating our role and why it's so important to work with a professional, much like an accountant, bookkeeper, or tax preparer, because there are very certain things that we can actually help the business owner do or understand that the software, the technology is just not going to provide. And honestly, there are a lot of nuances that they're going to miss out on that really could be quite a bit of savings. And that's where we kind of shine and as a profession can make a difference. But the one question I wanted to ask is, I am familiar with a number of firms that have chosen to also offer such services as you're describing, but in order to financially do so, I believe you have to be licensed. Isn't that true?
Yeah, definitely. So I think the basics from the insurance side is you need a life and health insurance license at least for a lot of the insurance products.
Yep.
So that's one thing. You're right. And then the other thing, that's on the insurance side. And then as far as financial planning, I think the minimum criteria on the financial planning side is the Series 65, which makes you a registered investment advisor. Then you can give financial advice. You can charge for fees under management. You could share. So I think that there's some ways kind of in the middle where, in order for you to get paid, like if you're an accountant and you send me a client, in order for me to pay you commission for sending that client, you have to be licensed, usually life and health insurance license.
Yeah.
But but to charge for me to pay you a fee, a referral fee, there's every state has a limit. Like some states have like a $50 a case, others have it at 100, 150, depending on the state. There are limits to how much you can refer. So I think there's some ways that you can not necessarily get around it, but some ways that you don't always have to be licensed. It helps a lot. And I think that if you're definitely, if you're a CPA, you could pass the life and health insurance license in like a week. It's a very simple for somebody who is a CPA, I think, just because the CPA exam is far more rigorous than life and health insurance licenses. But yeah, you're right. There's licenses involved. But I think maybe just having the referral partnership with a financial advisor, insurance agent could probably change some of that. It helps out because the overall benefit of being licensed is that you can have the fees go directly to your firm.
Correct. Yeah. So what we're talking about here is if a firm were to choose to offer such services or refer individuals to financial planners, if they chose to get licensed, there is a commissionable transaction that can happen and obviously bring in, as you're describing, additional revenue. So I think that's definitely worth considering. And I do know firms that have chosen to get their license. In fact, I know of bookkeepers and such that have come from the insurance industry that have their licenses and they just leverage them this way. So what you're describing is very possible. And those that are my listeners that maybe have had a work history where they once had, maybe they can quickly go out there and revitalize that license that they once had. The other question I wanted to bring up regarding your role as the financial planner is, do you have an example of how it's proven to be beneficial to work with an accounting firm. What kind of advantages have you been able to bring to the client's benefit having a financial planner and accountant working together?
Yeah, definitely. I mean, so a couple of things. So one, the client doesn't have to worry about, like, if they did this financial plan, is it going to have a negative impact on their tax situation? So when we have the accountant there, we can mitigate that risk, right? So I'm not giving out tax advice, nor is the client going to research something on their own and come up with their own tax opinion. They'll have a professional help them with that, which is key, which goes back to what you mentioned earlier. We need to, as accountants, need to provide more of that value, so that way they don't go to, TurboTax or some other platform to do the taxes on their own. This is where the value part comes in. And then vice versa, the accountant doesn't have to just, because it's kind of like a win-lose situation, where if the accountant only talks about taxes, it's good because they can only focus on that. They know that, but it's also potentially bad, because what if the client goes to another financial advisor that has an accountant, and all of a sudden now you lost that accounting client? So when you have an accountant and financial advisor working side by side, it helps both of them retain, and it also helps both of them give the advice and the opinions they want to give, and it helps both of them mitigate the opposite risk, right? Like, if I gave somebody tax advice as a financial planner, that'd be a huge risk on my part, and vice versa. If the accountant gave financial advice, that could be risky on their part. But when you have both of them, both the professionals, so yeah, it makes clients feel a lot more comfortable. And this is essentially what a family office is, right? A family office is essentially a group of professionals. You have an accountant, you have a lawyer, you have a financial advisor, you have all types of an analyst, a financial analyst, and they take care of everything for the individual, from the tax side to the business planning side, legal side. And usually family offices are, for the most part, available to the top 1%. The ultra wealthy have family offices that handle all of their legal and tax and financial advice, because it costs a lot of money. It costs a lot of
Oh
money
yeah.
to do that, to have all those professionals working on just one person. But if you can kind of offer like a virtual family office, or something similar to a family office approach to clients, I think that'll help the accountants a lot grow the practices. It'll help with retention. It'll help the financial advisors grow. I think it'll definitely incline people to work with you, bring more referrals if you can give people that extra attention.
Yeah. Well, I think there's a complementary role here, and I can just be proof of that. The best referral source that I have for our business, where we work with business owners as we provide business coaching services, the biggest referral source that I have is a financial planner. She's amazing. She sees basically clients all the time, and as they identify as business owners, she first and foremost stresses the importance of working with a business coach, asks whether or not they have, and then in turn refers them to us. And the nice part about it is, as we address their business and their accounting situation, we're able to then complement what they're hearing from their financial planner, simply because the whole goal of the business is to give them the resources they need to live the life that they want, maintain a lifestyle, have a lifestyle, and hopefully at some point retire and retain that lifestyle. And if we're working with the financial planner, there are a number of things that we're able to implement in the business today to achieve that, and more importantly, work towards that. Whether they wish to sell the business or merge, basically get out of it what they were hoping to, as we value what that business is ultimately worth. So this is, I think, a very tried and proven business philosophy in my mind. Now, the question I have for you is, from a financial planner's point of view, how do you vision money differently than you think an accountant may? There's the financial planner perspective of money and the accountant's perspective of money. I was just curious if you could maybe share some thoughts on that.
Yeah, so based off my experience, I don't want to generalize and say all accountants are like this, but based off my experience, I've seen that for a lot of accountants and tax filing, it's more of, how much can we save this year? What credits can we apply for? What deductions can we get? Maybe next year, like mitigating taxes. But I don't, and I think it's more of a short term. Again, I'm not saying that accountants are short term thinkers, not at all. I'm just saying that that's how the logistics of a lot of businesses work. Accountants are usually, from what I've seen, overwhelmed. They have a lot of clients. A tax season is a very overwhelming time period. So it could be too much for an accountant to think, well, how do I save taxes over the next 20 years? And I think that's one of the biggest differences is financial planning. I help clients kind of mitigate taxes long term. Again, I'm not saying that accountants are short term thinking, not at all. I'm saying that the way that the logistics of how businesses run and how small businesses are and tax season and all the time constraints, that it's more of a short-term process of tax filing and getting the most deductions and credits in place. As a financial planner, I definitely have, I'm thinking over the next 20 years, and then also in some situations eliminating taxes. Like if we use Roth IRAs, if we use annuities inside of Roth IRAs, using cash value whole life insurance, we could completely eliminate taxes, have zero taxable income in the future. So that's kind of the differences. Also, accountants are usually, from what I've noticed, they're talking to a client. All right, you're a client. You're making $100,000 a year. That's a current situation for the client. They're making $100,000 a year. Whereas I'll talk to a client that's making $50,000 a year, but I definitely see them making more money in the future. And it's obviously my job to help them grow their income in the future, and as well as their reserves that they'll have in the future. So it's a little bit, it's similar, but the differences are as far as the difference between tax filing and tax planning.
Yeah, yeah. No, I like that explanation. The way I would add to that is when I'm working with a business owner and we're addressing their accounting situation, our goal is to help them make money, both on a W-2 level, dividends. We're trying to help the company be profitable. And so we're looking at different things that we can do decision-wise in the company that will impact those margins. Well, at the end of the day, all this money's been made. It's nice for me to be able to have a financial planner that I'm working with to say, okay, after all this hard work has been done and the money's been made, what do we do with it? And the business owner, with their success, they're happy to kind of keep some money in the bank. But at the same time, I want to encourage that they diversify. And as they diversify, they're going to be putting money elsewhere. And for them to work with a financial planner to figure out what those strategies might be and look like is helpful and very important. The other thing I would say is, conversely, the financial planners, they're working with business owners. They're finding that the business owner may not be leveraging their business as much as they can, or more importantly, they're not as profitable as they could or should be. And so they then refer them to work with me. And as such, I'm able to get in there and figure out how to actually make the business more profitable. So at the end of the day, it's a great symbiotic relationship. And I really like that. So here's what I want to do. I want to wrap this up a little bit here. Real quickly, I wanted to ask how listeners can connect with you. You talked about your podcast. What is that again? And then how can the listeners actually contact with you?
Yeah, so they can go to thinkinglikeabank.com. It's thinkinglikeabank.com. They can go there. They can download an ebook, connect with me on LinkedIn, YouTube, send me an email, schedule an appointment. All that can be done through thinkinglikeabank.com.
Perfect. Well, I'm also going to be putting for the episode listeners in the episode description a link to that. So if you didn't capture it, definitely go to the episode description and you'll easily find there the link that you're needing. In addition, I'll be providing some additional resources for our listeners. They're in the episode description that you'll want to take advantage of, one of which are two books that you'll definitely want to add to your library. One is In the Black, 9 Principles to Make Your Business Profitable. It is a how-to guide for us as accounting professionals to work on our business, addressing the short-term, mid-term, and long-term needs that our company has. And in addition to that, a book called Red to Black in 30 Days. It is literally the how-to guide for us as accounting professionals to work with our clients and give them the resources they need to manage their cash flow and go from red to being in the black. It's a definite must-read for all accounting professionals. So go to the episode description to get a copy of each of these and really put them to use. And let's see what we can do to further help our clients as we work with them as accounting professionals. Now, as a summary of our conversation, I think there's a few highlights here that as accounting professionals we need to consider. First and foremost, there is a great symbiotic relationship with financial planners. And if you haven't already, through your networking, identified a financial planner with whom you can work, I would highly recommend that you do so. Having a financial planner be someone that you can take your clients to and conversely get referrals from is a great thing for you to consider. As for business clients, one of the things that we need to understand for them and for our own businesses is there's a lot of ways to manage wealth. And I thought some of the things that we discussed today were very important to consider. I brought up the key man insurance. We talked about the whole life insurance, putting together policies wherein the retention of the employee is done through the fact that they're offered a policy, but only available to them after they've vested a period of time, and then they're able to access the equity in it, as well as the death value, the death benefit of it. So there's a lot of things there that you can do for employee retention. And then at the same time, it's just great ways to manage or hedge your efforts to stay ahead of inflation and really kind of build a nest egg over time for when you're ready to retire and exit out. So definitely, if you haven't already, make a relationship, build a relationship with a financial planner. In fact, feel free to reach out to Sarry and see what he may be able to do, because he may in fact be the solution that you're looking for. In addition to this, I do want to encourage you to find out what more you can be doing for your clients to actually help them take advantage of different resources out there. We talked about the 401k. I mentioned the HSA fund. There's just a lot of things that can be done to really leverage your financial well-being. So here's what I'm going to do. Obviously, listeners, I want to encourage you, if you haven't already, to subscribe to the podcast. We've got a number of episodes that you'll want to go back and listen to. Definitely consider binge watching those. Set your subscription to alert you as to each and every time we release a new episode. We've got them coming out on a weekly basis. So you've got that notification. You've got our past episodes to go back and listen to. But at the same time, I want to invite you to attend our GrowCon event. Each and every year we have an event, a conference for business owners to literally come as they're working on their accounting, bookkeeping, and tax businesses. This is a conference for owners of firms to actually give you access to the experts, visit and interact with peers, collaborate with basically those people that are doing and being successful at operating the premier accounting firm in their area. And in doing so, come out and just relax. And so check out information regarding GrowCon 2023, as well as any other year that we may be doing this. The other thing that I wanted to invite you to do is, if you're interested in applying these principles or learning more about them, is to visit us at universalaccountingschool.com. There you'll find a variety of resources available that you can take advantage of, or you can give us a phone call. You can reach us at 801-265-3777. And always remember this: if it's about accounting, it is universal. Take care, have a great day, and be safe out there.